Good evening, all.
Good evening,
Good evening,
ma'am.
ma'am. Good evening.
Good evening, madam.
Is my voice clear? Am I audible?
Yes, ma'am.
Yes, ma'am.
Yeah, clear.
Your guys' voices or no, like it's breaking in between. So that's why I want to make sure. 1 second. Okay, so hope it will be fine. So yes, so new topic, management accounting. So how many or no like have took accounts as the a subject as one of your subject in your higher secondary? Just you can raise your hands. Okay, very few.
Sorry, ma'am, I didn't hear the question. Can you repeat, please?
Okay, so I was just asking how many of you guys took management, took accounting, had accounting as one of your subjects in your higher secondary. Okay, okay. Okay, okay, fine. Okay. So very few. Okay. So I can start off from the basic, right? For other students, the other participants, as well as for those who have already gone through these accounting concepts and all the topics related to accounts in your higher secondary. So it will be like fresh up, okay, for you guys. So let's start. So let's go on with the introduction. So what is accounting? So accounting is it's a statement of all the transactions, monetary transactions. Okay, not just general transactions. It's the monetary based transactions happening in an organization. So recording all those monetary transactions in those concerned accounting books, journals, subsidiary books like journals, ledgers, and other final accounts book, so the total activity of registering and recording of all the transactions, so that is called as accounting. Okay, so it's like a record keeping in an organization from the point when the organization has come into the view. From the point when the company has started off its operations. So from that point onwards, all the transactions, all the monetary based transactions are recorded. Okay, so why it is needed? why do we have to record the transactions? Yes, why do we have to record? Any one or two can answer.
To know the profit and loss, like that.
Okay. Okay. And then?
To monitor our budget, for example, to record our liabilities on our like receivable amounts.
Okay, fine. Okay.
For
So what the
analyzing,
company, I'm sorry, yeah.
for analyzing the transactions.
Analyzing the transactions. Okay, so they just want to know where their funds are like flowing. So where their funds are flowing, which activity like costs more and which activity costs less, and where they have to like invest to more and where they have to like retain. I mean like pull back the like the I mean the money in which is being like spent. So no, they will get a general understanding. So when you comprise everything, whatever like activity the management or the organization of the the management of the organization is like taking. So this record keeping by going through these like past records of all the transactions, or by viewing the present record based on all the transactions which is happening right now in the company, it helps in decision making process. That is the main reason why accounting is not done. Okay, so it helps the management, it helps the organization in decision making process, decision making in allocating funds, decision making in allocating resources, decision making in like where to like involve more cost, where not to involve more cost, and decision making in like how to deal with the debtors or how to deal with the creditors. So what is the profit, what is the like loss for like for the past few years or for the past few months or past few weeks. Okay, so to based on these data, decisions are taken by the management of the organization. Other than that, not only the organization, few other parties which is closely related to the management. So what will be the who will be the other parties? The shareholders of the company, and like the legal bodies, and the competitors. Then even the competitors want to know how the other organization, their competitor, is like progressing. So by seeing their accounting like the recorded data, so they will come to know how their competitor is like progressing in the industry. And like for investors, for stakeholders, all the stakeholders, these data is like necessary. And not only that, even like for regulatory bodies, like because the company has to file the tax. Okay, based on the revenue or based on the profit like it's generating, they have to pay the tax. So the concerned authorities need these accounting data to like assess the taxing capability of the organization. Okay, so finally, when you're like it's a like these records this communicates with the not only with the internal employees in the organization, not only with the management, but it also communicates about the company's progress with the external world. So these external world, it includes all the competitors, the government bodies, the legal organizations, the regulatory bodies, and like the investors, potential investors, and the present investors, and shareholders and stakeholders and everyone. Clear?
Yes, ma'am, clear.
So now we are going to see about the users and beneficiaries. So who is going to get like benefited by these like accounting data? So when a company like comes up with the complete data of all the accounts, all the monetary based transactions, and they publish it, okay, in their journal or in the ledger or in their profit and loss account or in the balance sheet or whatever, and finally they publish in the like in a gazetted paper or whatever, okay, when they submit it to the government. So who are the parties who are interested in one the company's accounting data? So who are going to get benefited from these accounting data? So let's see one by one. So first party is the owners and investors. So based on the accounting data, so they can decide on like whether to invest more in the company, and by seeing the profit and loss account, they can decide on what is the profit like for the past 6 months, whether the company has somehow managed to generate the profit with the resources available, with the production what they have made, with the sales what they have made, and what is their percentage of share, everything so the owners or the investors, they will get all the information by seeing the accounting data. And then is the management. So each and every aspect of the management, that is each and every contributing party to the management, all the departments, the marketing and sales, the accounting, the HR department, the operations department. So each and everyone needs these like accounting data for like decision making purpose. So after deciding, they will come up with their decision to the management, and once the management approves their decision, it immediately gets implemented in the organization. Okay, so mainly it helps the management in decision making process. Creditors, all the creditors who have lended like money to the organization, or who has like lended the other forms of like benefits to the organization, other forms in the sense like tangible things like furnitures, or the the buildings, the machineries, okay, so they would have lended like to the organization for quite some period. So they are interested in like seeing the accounting data of the organization, because to make sure the organization is doing good. So then, so that like they are um, they can feel risk free, they can feel risk free, and believe that the organization is going to pay back to them, because the organization is not doing good. The government, regulatory agencies. So who are these regulatory agencies? The taxing people, and the taxing bodies, and the cost accountants, who are helping the organizations to file the tax returns at the end of each term. So these are the regulatory bodies who are interested in those accounting data. They need those data for further proceedings. And then government, of course, the government always like cross checks with all the companies records related to its what are, how the cash flow, how the monetary items like flows in the organization. So where the cash is like going, who's the investor of the like capital, and what is the background of the investor. So whether he has got a loan from the bank, or it is his own money, how it happened, like everything, so the government bodies are interested, government and legal bodies. And potential investors, or like other stakeholders who wants to know how a company is like progressing, so that they can come with the investing interest. So they have not invested, they have not invested as of now, but they are potential investors. So after analyzing the data, if they feel that no company is doing good, so it is showing a good result in the profit and balance account, profit and loss account, so it's progressing, they will not decide on like investing in the company. Okay, so investors are indifferent, potential investors are different. Investors, they have already invested in the organization. Potential investors, they are waiting for the opportunity. So after analyzing the data, they
ആരെ
will go on with the investment
അതാണ് പെട്ടെന്ന് ഇടുമ്പോ
decision
ഇടണാണ് അത്
making.
നമ്മള്
Clear?
അല്ല
Please me.
Okay. Please make sure you're muting the audio, no? Like all the background noises is disturbing the class. Okay. The other people or no, like employees of the organization, why they are interested in the transactions of the organization, the monetary transactions of the organization. So they want to make sure they are working in a like safe environment. Since the company is like progressing very well, though they can make sure they are working in a very safe environment. So they can like stick on to the company for quite some period. They don't have to like quit the job and go for like some other company which is doing good. So the employees have to know, not only the employees, each and every department in the organization, they need these data, they need this data for making decision making progress. And researchers, finally, researchers, why do they need is like they want to conduct like research on few things, economics based research, or like monetary based research, or inflation of a country, like a based research. So commercial based researchers, or like sales based researchers, whatever production based researchers, whatever the research is, like in terms with when it like in terms with the organization, they need these like accounting data. So these are the parties who are like getting benefited from these accounting data. Clear?
Clear.
Is it clear? Okay, fine. And now we have 5 account types. These are the basic account types, but like if you see the recently published books, and like now accounting concepts are like from conventional way we have like moved to like modern accounting concepts, and like many things. But basically if you see these are the 5 basic accounting types. The first one is assets. So asset account type is like the cash, ready cash available in the company. The property, if it is the own property of the company, of the organization, so it comes under assets. Equipment, that again if it is like company's own equipment, not rented or leased. If it is company's own equipment, that comes under assets. Vehicle, company's owned vehicles. And accounts receivable is they have given the product, given the service to the customers, so the customers are yet to pay back. Okay, so those are accounts receivable. So all these comes under assets. Then liabilities, like the company is like obliged to pay to the liable parties, okay, to the other parties, the external parties. So what comes under liabilities is the bank loans. So whichever loan they have like received from the bank for for organization procedures, activities, and they have to pay it back anytime, they have to pay it back. So that comes under liabilities. Accounts payable. So the organization would have purchased something like raw materials or machinery or furniture, or they would have taken a space for storage purpose, or they would have rented or leased a building for going on with the organizational activities. So those things they have to know, like for using those aspects, they have to pay for it. Okay, so that comes under accounts payable. Then credit cards is like something new, but here we can mention in organizational view, we can mention it as other creditors who has like lent to the company, from whom the company has like got loan, or got like any kind of monetary value. Okay, so which has to be paid back to them. So that also comes under liabilities. Unearned revenues, or something like if the goods has not been like sold at all. Okay, so that becomes a liability, because They have invested in procuring the raw materials, invested in production, invested in everything, invested in manpower, but the final product, it's still in the company storage unit. It's not like moved out of the storage unit, because the demand has there is no demand for that particular product anymore in the market. Okay, so in that case, that product becomes a dead stock or a obsolete stock for the company. So those things, it's a liability, because that's like a loss. Okay, that's like a loss already. Money has been spent for producing that product, but the company hasn't earned anything out of that. Okay, so that comes under unearned revenue, which comes under liabilities. And customer credits, whatever they would have purchased something from the customers in the sense, the stakeholders, that is whoever is supplying the products to the company. So they have to pay it back. The organization has to pay back. So customer credits. So these things comes under liabilities. That is, the organization is liable to pay. That is, obliged to pay back. Okay. Then equity. Equity is share. So owners equity, owners would have invested on the in the company. So owners equity, owners draw, whatever owner has taken back from the company, owner's contribution, and not only the initial capital, but even after some time, as the business grows, the owner would have invested more, donated or contributed more, and that comes under equity. Common stocks, other common stocks available in the company, like buffer stock, safety stock, all other stock, finished goods, everything. So that is equity. Then retained earnings. So whatever extra amount which received because of good interest rate and everything. So those are retained earnings. So these things comes under equity. And revenue, sales is a revenue is something where you can immediately you can take back and share with all your investors. So revenue is something you can take back and keep it for rotational purpose, keep it for a day-to-day rotational purpose for the running of the company. Okay, running of the organization, smooth running of the organization. So sales, okay, so when sales is made, money comes in, so that becomes a revenue, and you can use it for daily operational purpose of the company. Royalties of the company, and cost of goods sold. Okay, and then expenses. So expenses are something wages, salary, rent for the rent, or the lease amount for the building, where the company is actively active, and phone bills, electricity bills, and the conveyance charges to the employees and workers, all the utilities they are using, what do you say, this water, and tea, coffee, beverages, or food, free lunch for their employees. So everything comes under utilities. And if the company is providing transportation, free transportation, so the company is investing in transportation also, so it's a free transportation, right? So that also comes under expenses. Okay, so these are the 5 basic account types: assets, liabilities. Assets are something that is completely belongs to the company. Okay, so anytime when the company is closing down or shutting down, the assets will always be it can be readily cashable. Okay, and liabilities is something which the organization is obliged to pay to the external parties. Equity is something whenever the company wishes, the organization wishes, it can take back from the company's profit or company's capital. Revenue is something where from the amount, that is the amount receivables which comes to the company by through sales of goods or through royalties and everything, and which can be used for the smooth running of the organization on a daily basis. And expenses are something that it has to be paid off. Okay, so wages, salaries, rent bill, phone bills, electricity bills, and no other utilities. So that comes under expenses. Even no like insurance. Insurance, the company is no like paying this. That also comes under expenses. Okay. Is it clear?
Yes,
Yes,
ma'am.
yes.
Okay, fine. Good.
Yes.
See, I'm going little slow, okay, because these concepts, no, like I cannot, no, rush it off, okay. That's why, no, I asked you guys, no, like how many or no, like already have a, no, like a general idea about, no, like accounting. And I saw that very few have, no, like taken accounts as your subject in your higher secondary, and most of you, know, like has not. So for their no like better understanding, I'm going to go little slow, particularly on this subject. If it is okay with you, I can no like continue in the same pace. Fine.
Yes.
Yeah.
Make
So
it little slow.
even slower. Oh my god. Okay. We will make it even slower when we are no working on the examples. Okay. So that will do, because initially I cannot know like come up with no like the examples, no like the accounting models and sums, because it will be very confusing. So initially you have to understand the basic accounting concepts, terms. You have to understand what is revenue, what is a liability, what is a debenture, what is a capital, and many accounting terms are there, no like at least know the basic accounting terms you have to know. You have to first understand what is what in accounting. Then we are going to see about who is in the accounting, who are closely related in the accounting. Okay. So who is a debtor, who is a creditor. Okay. So these things we are going to know like see. And then know like after 2 or 3 sessions, we will know like slowly opening up with the examples, small examples, and we will be know like going on with the extensive examples to know like for better understanding. So like when taking up the examples, I can no go even no like even slower. Okay, so now we are no like having 3 branches of accounting. You have financial accounting, cost accounting, management accounting. Management accounting, no like it mostly deals with the internal accounting. I mean all the accounting data, no like which is no like the recorded, no it is completely for the management purpose. That is, it helps the management of the organization for decision making. Okay, so this accounts prepared for no like for management, to help management, that is that will not be shared with any of the external parties. Okay, clear? So management accounting is something prepared within the company, and no this is to be shared within the company, and especially only with the management. Financial accounting, yes, that is to be shared with the external parties, especially with the no like government bodies, if they request, even with the no like investors if they request, because financial accounting, no like profit and loss account, balance sheet, no that comes under financial accounting. Funds flow, cash flow, everything comes under financial accounting. Cost accounting, like no like it's an extensive subject. Cost accounting, extensive. Okay, so and it's no like very narrow, no like based on the management financial accounting concepts and everything, no like the cost accounting can be prepared, or with the basis of financial and cost accounting, the management accounting can be prepared. Okay, so in that way all these 3 branches of accounting help each other. So let's see what is the difference between these 3 in detail. Okay, the first point of difference is what it deals with. Which accounting deals with what? So cost accounting, it deals with ascertainment, allocation, apportionment, and accounting aspect of cost, where and all cost is involved. Okay, completely, it relates with only the cost, how much the company is spending, on which aspect the company is spending more. So where is cost completely accrued, where it is mostly needed. So that is the the important aspect on which the cost accounting will be prepared. Management accounting is concerned with the analysis of accounting information in such a way that helps in taking management decisions. So this is only for internal purpose, that is the organization's internal purpose. Financial accounting information in general way and tells about the profit, loss and financial position of a company. So if any external body wants to know the financial position of a company, they can just go through the financial accounting statement of the company. Okay, so financial accounting is for the external parties and management accounting is for the internal parties of an organization. Cost accounting is something you cannot say that it shouldn't be shared with any of the external parties, but in case while submitting submitting the tax returns, and whenever any legal body or government bodies demanding for any such kind of so where your cost everything has gone into. So in those situations, cost accounting, the result of the cost accounting, that can be shared with those concerned parties. Okay. So otherwise, you don't have to share cost accounting details with the external parties. Only if demanded by the organizations which are in the which directly or indirectly contribute to the management's the smooth running of the organization. Okay, second point of difference is form of accounts. So for cost accounting, there is no prescribed format. There is no prescribed format. So completely it comes with no calculations, few formulas are there. There is no prescribed format, like this is the format how you have to write. This is how you have to separate the column, and this is where you have to mention the creditors and debitors, and whatever incomes have come, this you have to post it here. So there is no such rule at all. And for management accounting also, there is no prescribed format, because management accounting is derived from the results of cost accounting and financial accounting. Okay. And financial accounting, as per the requirement of the Companies Act and income tax. So only in financial accounting, you have a prescribed format. So left side, right side, creditor, debitor, and incomes and expenses, profits and losses. So in which column, which entry should come, and know how to balance it. So those rules and regulations, it's completely, it's followed in a very prescribed manner only in financial accounting. And the third point of difference is base. So basis cost accounting is prepared on the basis of the result of management accounting. Financial accounting is also, it provides the base for management accounting. That is, based on the financial accounting results, management accounting is derived. So from management point of view, if you see, it's derived from financial accounting and cost accounting. So these are the basic three differences. There are many differences, but right now, as of now, we will go through these basic three differences. Clear?
Yes.
Okay. Yes. Okay. So to sum up, 3 points you have to remember. Financial accounting, it's for the external parties. Management accounting, it's for internal circulation to help management in decision making. Cost accounting, it can be shared with external parties if they demand it. I mean, the external parties should be in the position of demanding it, like government bodies, legal authorities, it should be in the demanding position. In those cases, it can be shared. Otherwise, there is no need to share. And and only financial accounting has a prescribed format for entries, like where to put the entries. Otherwise, the other two accounting types, that branches, that is cost and management accounting, there is no prescribed format to like enter the data. And base is like management accounting is like derived on the basis of the result from cost accounting and financial accounting. Financial accounting provides the base, whereas the cost accounting takes the base from the management accounting also. That is, management accounting or the results, it can be helpful in like creating cost accounting. Is it clear?
Yes, yes. Yes, ma'am.
So first we will know like for sometime in the sense, so for next few sessions we will know like see about the management accounting, and then like we will know like I will take you through the financial accounting. Okay, so initially we don't have to confuse both at the same time. First we will go on with the management accounting, because management accounting mostly like you will be having like mostly theory basis, 60% at least, like 50 to 60% it's like theory basis, the remaining 40% will be like calculations basis. Okay, so management accounting, it has another name, managerial accounting. So both are one and the same, managerial accounting or management accounting, both are one and the same. Okay, so what is the difference? I mean, both are one and the same. So the statements, reports, documents, and everything, like it's prepared based on the financial transactions. With all the financial transactions, all the entries which is like recorded in the financial transactions. So that is the base for preparing the management accounting. So what does it do? Mainly helps the management in decision making process. So when and all management accounting should be done, for example, financial accounting, it can be done on like once in a quarter, that is once in every 3 months, or once in every 6 months, or once in a year. Mostly organizations do the financial accounting once in a year, every year ending, to file the taxes, to show the like the profit and loss account of the company, to publish in the like gazetted papers and everything. Mostly they do it once in a year, that is at the end of the financial year. But management accounting you can do any time, because like for each and every decision making, like in all the aspects, like whether it is any department, in spite of like any department based decisions, so it needs the like data from the management accounting. So anytime it can be prepared on a daily basis, on a weekly basis, or like fortnightly basis, on a monthly basis. So anytime at the point, anytime the management accounting can be prepared. Okay, and immediately the results are interpreted and communicated to the management for decision making purpose. So yeah, there are like two basic principles in management accounting. The first one is principle of causality. Causality, that is the need for cause and effect insights. The need for cause. So why it should happen, how it should happen, when it should happen. That is when they are like deciding on like investing, or like selecting a perfect supplier, okay, for the company. So why they are not selecting that supplier? Because of the cost involved, or because of the materials, like the supplier is providing to the company, the quality of the material, because the supplier himself or herself like is taking care of the transportation part, like this the material, this all the raw materials, the supplier is like transporting to the production unit, or to the company. So the company doesn't have to use any transportation from its side. So it reasons may be many. So it's the cause, principle of causality, the need for the cause and effect insights. And the second principle is principle of analogy, that is the application of causal insights by management in their activities. So you're applying the causal insights. First, you're checking the causal why, when, how, and you're applying those causal insights in their activity. So principle of causality and principle of analogy. These are the two basic principles. We will now see about this in detail with no appropriate examples in our next session. So we are coming to the process of accounting. So how accounting is done. So there is a process, there is a step in, each and every activity. There should be a step, to be followed, a process to be followed. So accounting, you have to follow these steps, without confusing or without, interchanging. You have to strictly abide to those accounting rules. So we cannot change according to our comfort or our ideas and everything. Okay, so there is a prescribed format for preparing the accounts, and that format has to be strictly prepared, and all the rules and regulations has to be followed mandatorily. Okay, so the first process is the first step, okay, in accounts preparation is identification of financial transactions and events. First, list down all the financial transactions. Start with the capital. First is capital, and then renting or buying a building or leasing the building. Okay, and then intake of the manpower, how much you're paying for that. I mean the workers and the employees, and then is fixation of utilities, electricity, whatever, the other fixtures, furnitures, how much you're investing, and what else. The company has to run on a daily basis, day-to-day basis. There should be a an allocated fund should be there for for usage of the company's running. So that has to be allocated, and those funds has to be always readily available with the accounts manager. Okay, so for few companies, it could be 5,000, or a very small company, or for other companies, some middle level companies, it would be 50,000 to 60,000, and for higher companies, it could be around 2 lakhs to 5 lakhs. So everyday basis, on an everyday basis, they need this money for rotational purpose. Okay, so that also should be recorded. That amount, that investment, that is also to be recorded. And getting a loan from the bank, that is to be recorded. So identification of all the financial transaction, wherever money is involved, whether it is given or taken, it should be identified. Then whatever identification, whatever transactions and events you have identified, and you have to measure those transactions in terms of money. That is, how much is spent for procurement, how much is spent for manpower, how much is spent for machinery installation, how much is spent for building, purchase of the building, how much is the capital. Okay, so is that now the capital is from a single person, that is the owner has invested all the capital, or if it is from shareholders. If it is from shareholders, each and every person, how much is the share they have invested. Okay, so everything should be in terms of money. That is, whether it's thousands or hundreds or tens or lakhs or crores, whatever. Okay, then recording those transactions, you have to sort out those recordings, and you have to make the entry in subsidiary books and journals. We will see about what are the subsidiary books and journals. So this transactions has to be recorded in journals and subsidiary books. After completing the journal entries, you have to classify those transactions in ledgers. classifying is like all the receivables, amount receivables in one section, all the amount payable in one section, all the like debtors in one section, all the creditors in one section. So you're classifying the transactions in a ledger. Then after the completion of like ledger entry, you're summarizing those transactions under trial balance. First, you need to prepare a trial balance, and in trial balance, it should be the balanced statement. That is the credit statement and the debit statement. It should be a balanced statement. So once there is a balance in the statement, you have to prepare a trading and profit and loss account. Okay, so this is more than enough. That is still profit and loss account. That is like more than enough to prepare a financial statement. But like mostly companies like they go on with preparing balance sheet as well. So balance sheet like few external parties, they may ask only for profit and loss account, but few parties they may ask for balance sheet as well. So it's always better for the organization to prepare profit and loss account and finally the balance sheet. Okay, and then once all these like bookkeepings and everything is prepared, then finally analyzing those accounts. What are the final accounts? Trial balance, trading profit and loss account, balance sheet. These are the final accounts. Especially the profit and loss account and balance sheet is the final accounts. So by seeing those like accounts, all the data printed in those like accounting summary, you have to analyze it. Analyze where and all the cost is like involved more, in which aspect the company has spent more. So is it like worthful or is it not worthful? Whether the company can go on with the same proceedings or they have to minimize the cost, or they can go on with investing more, procuring more, purchasing more, or like recruiting more. So everything has to be analyzed by seeing the final accounts and interpreting the results. So you cannot give the results as such. That is, all the statements you cannot give as such to the all the departments in the organization. So it should be like in a way that they can understand. So if somebody happens to see a profit and loss account, if that person is from the accounts department, the person can very well understand what is all in this company, where is the exact, what is the exact position of the company. But show the same account statement to a HR person, that person may not understand what is this, what is the statement, okay, why you're showing me this, so what I should get from this, what I should understand from this. That will be the question. So for HR department, for operations department, the results, the analysis done, it should be interpreted in such a way that they can understand. Okay, and communicating the results with all the other parties in the organization as well as with the external parties. Clear?
Yes, ma'am.
Yes. So this is the normal procedure for like accounts preparation. And most of these it's done in financial accounting. Financial accounting you can like start with like, because this is a prescribed format to be followed. Okay. So this prescribed format is like strictly like followed in financial accounting only. For management accounting and cost accounting, you have like different formats, not even formats, those are very simple accounting types. Okay, because financial accounts at a basic kondana, you have to like prepare the management accounting, management account concepts. Okay, so this is all about for today, because I don't want to like give you like like stuff you with more information on the accounts. So this is all for today. So what we saw today is what is accountancy, I mean what is accounting. It's a recording of all the financial transactions, and for what purpose? For decision making purpose, and for like for users and other beneficiaries. So who are these users and other beneficiaries? Owners, management, creditors, regulatory agencies, government, potential investors, employees and researchers, they need these accounting transactions, accounting data. So 5 basic account types: assets, liabilities, equity, revenue, and expenses. And 3 branches of accounting: financial, cost, and management accounting. So management accounting is derived based on the results from financial and cost accounting. And financial accounting is for external parties, and management accounting is for internal parties. And then management accounting, which is otherwise called as managerial accounting, and especially for decision making purpose for the company's management, the organization's management. And there are 2 basic principles, that is principle of causality and principle of analogy, and the process in preparing the account statement. Clear?
Yes, ma'am. Clear.
Clear. Okay. So if you have any doubts, you can ask before we wind up the class. I know it's little too early, but again I can even add 2 or 3 more slide to this, but I don't want to stuff too much because since this is the first session of accounting. Any doubts?
Ma'am, that expenses, the wage, which means the salary, correct, ma'am?
Wages and salary. Yes, wages is
Salary.
which is being paid on a daily basis or weekly basis, fortnightly basis. Salary is something which is paid on a monthly basis.
Okay. So wage is a different one.
Wages are
Wages.
different. Yeah.
And regarding this, ma'am, that summarizing the transactions, the trial balance and that profit and loss and balance sheet, the 3 one is totally are different one, correct? Balance sheet is
all
totally
the
different one, that profit and loss account.
exactly. Yeah, and the format is also different, not the same format. Format also differs. All the 3 have different format and different way of giving the entries.
Okay. Thank you.
Yes. Yes. Anything else? Any other doubts? Okay.
No.
So now, okay, good. So let's meet in the next session. I'll share the PDF, the file, the material with you. And just the other sessions, usually what I would say is for my other students, offline students. So I am preparing the PPTs, I'm not exactly taking each and every line, whatever I am referring. So I'm referring many books, I'm referring previous, universities textbooks, and I'm referring contents from the internet and everything. Okay. So the basic things, and which can be, which can be made to understand, those things I am, point in points based on I am giving it to you. So for other subjects, whatever we have seen through, as of now, the previous subjects, so those will be very easy. Okay, even if you go through all the PPTs just 1 or 2 days before the exam, the concerned exam, so it will be very easy to understand. All you have to do is spend some time before the exam and just go through all the PPTs related to the subject. But when coming to accounts, this is not the case. So from the beginning, you have to be very cautious. You have to be very committed, and on a weekly basis you have to go through the materials, what I am sharing with you. Otherwise, if you think okay, just before the exam, we will take 1 week's time, we will go through all the PPTs, definitely it's not going to work. Clear? So please go through the material which I'm going to share with you, especially for accounts. Okay. So the more you understand the basics, the more it will be easy for you to understand the summarization of accounts. Clear?
Yeah, clear, ma'am. Sure, ma'am.
Yeah, very good. So have a great weekend. Thank you, and we will meet you next week.
Due to
madam,
my-
this material is still not received, madam, for me.
Which material? The last week's material?
Now going.
This one. Oh, this one just now I have taken. No, so after the completion of this
Ma'am,
class, I'll
I
be
didn't
sharing.
receive inventory management session 5 and 6.
You haven't received.
No.
But I've already shared. But let me check with the concerned representative. Okay, I have already shared. I mean, within one day, I think I have shared. Yes, it's already shared. But I think there is some technical difficulty in there, like that WhatsApp sharing or something. So in that case, what I'll do is I'll just check whether I can share in their email. If it is available, I will share in their email and they will share it with you. Okay.
Okay, ma'am.
Yes. Bye bye then. Have a great weekend. Bye.
Mom, I have one question.
Yeah. Yes.
Mom, can we have this lecture videos?
I am not the person, who can decide on this. You have to check with either Ms. Adira, or whoever is in contact with you, from the institute side. You can ask
Okay.
them. You can
Okay,
ask them.
perfect. Okay, perfect. Thank you very much.
Yeah. Bye. Okay. Bye, guys. Bye.
Thank you.
Bye. Bye.
Thank you.
Anyone wants to ask something? No. Okay.
Okay, ma'am.